Hey, good evening, everyone. Marty Mazzora here, 31st of March, 2022. Going to cover some ground this evening. Going to do a quick economic update for you, then a quick technical stock market snapshot for you, as I would normally do on the weekend. The economic update I would normally do on Friday or Saturday, but doing it this evening because I'm going to be out of commission from tomorrow morning until Monday. My wife and I are going to sneak away and get in a couple of days of skiing. But of course, our index scoring has to happen every week, and I like to be the one who does that. We'll call it a preliminary score that I'm going to talk about this evening because tomorrow we get the jobs number and we get the ISM manufacturing survey. Both of those are really important inputs to our index. I do not expect anything to come from the jobs report that would move us away from what is currently a positive score, but of course, if it does, we'll adjust. The ISM manufacturing index will probably continue to score above 50. But if we saw, trend change or an acceleration of the downward trend, that might change as well. So I'll update that. And if it changes, we'll talk about it next week when we do the macro update. So again, we'll do the economic report. We'll do a quick technical look at the stock market. It's been an interesting few days. And then I'll spend just a minute or two on the monthly update of what we call our equity market conditions index, and I'll tell you how that looks as well. And that one I don't have any visuals for, but I'll just talk you through it. So the macro index actually saw a nice 4-point pop this week from 19 and change to 23.4. Again, as I say every time, we still got sufficient daylight between here and recessionary conditions. However, you would sure think that recession is just right around the corner when you listen to so many of the pundits today who are getting very excited about the yield curve, specifically the relationship between 2-year treasuries and 10-year treasuries, which is represented by this blue line right here. When it drops below zero, okay, so this is the difference. This is the curve, if you will, the difference between those yields. When the 2-year is higher than the 10-year, it drops below zero, and that's called an inverted yield curve, and that is considered one of the most reliable recession indicators out there. And again, it just inverted this week, and I cannot exaggerate how excited folks who are generally bearish on the economy got about that, and they say, things like winter is coming, look out, so on and so forth. So I want to make a couple of points. One is that another important treasury curve relationship is the 3-month 10-year curve, and that's actually steepening still. And this is the one, I pulled up the Cleveland Fed website, and this is the only one they talked about, actually. This is the only one they referenced, was this 3-month, 10-month. So they're kind of hanging their hat on that and saying, no, the yield curve, by that comparison, is not anything that would signal recession like it was back here in 2019, like it was presumably back here in 2007, right? And then right here in 2000. Okay, so if we look at it historically, and let's stick on the 2s, 10s because that's what everybody's focusing on. Well, okay, so this was back here in mid 1989. You can see it was well over a year before the recession actually occurred, right? Here you had an inversion right way back here in 1998, and it was 2001 to 2002 as we had that recession. Well, sure, it did precede recession by quite the stretch. Even right here, when it really inverted aggressively, that was early 2000, and the official start date of the recession is right here in early 2001. And then inverted briefly in 2006, came out of it and inverted again. So just because the yield curve has inverted may very well be signaling a recession once again, but it's not necessarily tomorrow. And the other thing that I want to point out is that each time it's really when it steepens, re-steepens, if you will, and really comes out of that is when maybe you need to start worrying about recession. Although it steepened here and we didn't have one right away, it steepened here and we didn't have one right away, but here we did. So being below zero here on the curve is one thing, but that's not what really precedes recessionary conditions as much as the re-steepening of the yield curve from an inverted state. So why is that? Why does a yield curve inversion, spell doom and gloom for the economy? Well, the way it typically is explained is that the longer-term rates actually reflect expectations for Fed funds rates going forward, right? So if longer term you get out there and yields are declining, what it suggests is that the Fed is actually going to be reducing interest rates on the way to that point. And if they're reducing interest rates, that must mean the economy's in trouble, experiencing recession or recessionary conditions. The way I put it, I was explaining it to a friend yesterday, and it said on the short end, typically the 2-year is a real reflection of what the Fed funds rate is going to be. That kind of gets discounted in there, or in terms of expectations. When the 2-year really starts ramping up, that typically coincides or is quickly followed by increases in the Fed funds rate. And you could argue that as the Fed gets aggressive, that also tends to precede recessions. And people will say that the Fed typically brings on or causes recessions by tightening monetary conditions. So ultimately, you get to a point where the market, in anticipation of a weak economy, is going to buy that longer end of the curve and lock up a nicer yield for a period of time where they think actually yields are going to be falling. So in a sense, it's the same thing. Now, why the steepening before recession? Well, I think that would be anticipating a Fed that's going to be reducing interest rates in the very near future. So the short rates would actually roll over to anticipate a Fed cutting rates and getting very loose with policy, which is the opposite of when it increases ahead of the Fed tightening policy and raising interest rates. So that would make some sense, is that suddenly the short-term rate begins to drop faster than the longer-term rate, and that makes it steep, right? The short rate is now lower than the long rate. So folks, I kind of rambled and stumbled through that. I hope that made some sense. But if you're getting even the least bit below the surface in the financial news, you're running into this yield curves, signal that a recession is looming. I think you can tell in my voice that I'm not as excited about that as a lot of people are. I respect it. I've probably written a dozen articles on the topic over the years. But again, there's so much to it, and the Fed is very active in the Treasury market these days, and maybe there's some distortions there and so forth. So we'll consider it, we'll respect it. We can check that box. Okay, so let me jump in quickly. I'll speed it up a little bit and get to some of the inputs to our index. The PCE data came out, personal consumptions expenditures. Actual consumer spending rose by just 0.2%. Month over month, the expectation was for 0.5%. It did rise, but at a disappointing pace. Consumer income or personal income rose on a month-on-month basis by about 0.5%. The deflator, or the PCE price index, and this is the Fed's metric that they pay most attention to, supposedly, 6.35%. As we've addressed, inflation continues to ramp up right here. Consumer confidence is in the proverbial gutter. The University of Michigan, as I've been showing you, is way below the COVID low. The Langer Weekly Comfort Index is down big. And the Conference Board is beginning to roll over as well. So folks, I get that, the stores are full and there's job openings galore, and the jobless claims are, on a continuing basis, are literally at 50-year lows. But my, oh my, if these sentiment indices are harbingers of things to come, yeah, I could see why, other than the yield curve inverting, I think there are reasons to be concerned about what the go forward looks like for the economy. However, when we look at the Citigroup U.S. Economic Surprise Index, it's been wrapping up here of late. Now, this doesn't mean necessarily that the economy is growing robustly. What it means is that it's doing better than what economists had previously estimated, right? So when it's rising, the data is coming in better than expectations, and that's what that's saying currently. Quick look at commodities. That's a big deal. It's a big deal for our portfolios. We have a not small position in commodities. And so remember I said here that, while we are structurally bullish on commodities for probably years to come here, after this huge ramp up, we're going to see some real volatility. Came down. I think we were up in here last time we did this last week. You can see we've fallen back a bit. I can see a number of catalysts that would bring this down. A resolution or a ceasefire or a de-escalation in Russia and Ukraine, I think would see several commodity groups drop significantly over a short period of time. The U.S. announced this morning, the president announced that they're going to release like 1 million barrels a day from the Strategic Petroleum Reserve. I won't belabor that, but if you didn't read the morning note, I do kind of get into the weeds and get pretty critical of that process. And then lastly, one more look at the CRB raw materials index. And again, these are things that aren't traded in the futures market. So this is a real reflection of what's going on under the surface with regard to inflation. As you can see, that continues to rise quite steeply right here. Okay, so there you have your economic update. Generally mixed, little bit of an improvement. And let's quickly look at the technical trends here for the S&P 500. So here's the daily chart, folks. Remember, I drew this rectangle and I showed you a similar look back in the 2018 fourth quarter. And I said, we're breaking out of this. We had a pretty nice gap here day before yesterday. But folks, this is not a good look. Breaking out of this and then failing that, at least as of today, technically speaking, there's almost nothing worse than a failed breakout. Now, of course, this could just be a test of support right here. But you get back into this range and you find some momentum. And, this market could easily trade significantly lower. And I guess you'd say that's our base case in terms of probabilities during the course of 2022. It doesn't have to be that way. We've talked about catalysts that could push this thing up higher. I think the headwinds are extreme right here, and I don't think the market is really appreciating what it's up against going forward. And let's take a look at the 60-minute chart. We extended this rising wedge pattern here, and sure enough, we broke out of that quite notably. And then today's candle is a big one, right? So this was a bearish look, as I suggested yesterday, and then on the momentum indicators, a real bearish divergence on the MACD, and of course that's playing out. And then lastly here, let's just take a peek at the weekly chart. So I showed you that this week was really breaking through what would be pretty tough resistance again. As of right now, you can see how this candle, this is how high it got, but the body of the candle is right here and it's red, so we're down on the week as we speak. Futures right now are up a bit, so we'll see how things play out to finish the week. Right now we're at the end of the quarter, first down quarter for equities in a couple of years. Okay, and then lastly, folks, I'm just going to run through this with you. So, not long ago, we created what we call an equity market conditions index, and then we have a little 5-point equity market model. The index is has 12 components, and it scores a flat 0 right now. So it's actually improved the last couple of months, believe it or not. And what we look at is our analysis of the dollar, and right now that scores a neutral. The interest rates trends, that scored a negative. That's a weight on the market. Fed policy is a real weight on the market right now. Fiscal policy, we call that a neutral. We did get the infrastructure bill passed. It's back-end loaded more toward the 2024 election. There's still a big pending spending plan. I do think something's going to get passed before midterm elections. Right now, though, we're going to call fiscal policy neutral. Valuations are a big negative one. We look at price to earnings ratio. We look at the cyclically adjusted price earnings ratio. We look at price to sales, price to book, and we look at the market cap to GDP ratios. All of them scream really, really historically high prices for stocks. Sector leadership is a neutral. We track, cyclical and defensive sectors against the S&P. Macro conditions are a plus. As I showed you, our macro index is still positive. We also look at the copper gold ratio. That's been consolidating. That by itself would be neutral, but we're going to score macro conditions still in net positive. Geopolitics are a negative right here, as you might imagine. Technical trends on balance from a trend standpoint, the daily and the weekly, I have to say, is technically positive. Breadth has improved quite noticeably. Sentiment actually turned positive. And now, sentiment is a contrarian indicator for us. So when I mean the sentiment component went positive, what I'm telling you is that people are getting worried. So we have a net positive score, which means we have net fear among the 10 different components we look at in our PWA Fear Greed Barometer. And then lastly, credit market conditions are getting close to negative, but right now we're still scoring that neutral. So when you add all this together, the positives offset the negatives, so we have a 0, which isn't bullish, but it's not necessarily bearish either. However, our 5-point model, it's the dollar, it's the Fed funds rate, it's inflation, high yield spread, and the copper gold ratio. And then we just basically look at how they historically trend, leading to positive or negative market conditions. And right now it's negative, it's a -40. So economic conditions are not recessionary at this point, but as you know, we do have real concerns about the overall market setup. And I write about that each week. And therefore, we're hedging against big downside risk. We're still bullish on places like Latin America. We're actually pretty bullish on emerging markets across the board this year, which right now puts us in the minority camp, which frankly I like being in. So, folks, I'll leave it there. Again, you won't hear from me over the weekend. Be back Monday morning with the morning note for you, and I appreciate very much you watching and listening. Have a wonderful weekend. Take care. Bye-bye.